Last time, we covered double tops and double bottoms. Today, we're going to look at what happens when you add one more high and one more low to those patterns, and how that changes things. Triple tops and triple bottoms. We'll be covering 3 strategies today: the neckline breakout strategy, the pullback re-entry strategy, and a high probability entry strategy using volume and multiple time frame confirmation. Common misconceptions. After studying the double bottom, some of you might think that as soon as the lows line up, it's time to enter. But a lot of traders have this wrong. Before we get into the main content, let's clear up a couple of easy misconceptions. A triple top or triple bottom is not complete until price breaks or clears the neckline. 3 touches doesn't mean it's over. The pattern can easily extend into a quadruple or quintuple formation, or just resolve into a sideways range. If you enter short at the 3rd high and price pushes back up, that's a loss. Always wait for neckline confirmation before entering. Second misconception. Some traders assume that 3 touches is automatically a stronger signal than 2. More touches doesn't mean higher reliability. Reliability depends on the size of the pattern, volume, and the time frame you're trading. In fact, when the number of touches gets too high, you may be looking at a range-bound market rather than a reversal pattern. Volume and time frame at the point of neckline break matter far more than the number of touches. You can have 3 touches and nothing happens. You can have 2 touches and a strong reversal. Don't fixate on the number. Watch the neckline and volume together. The basics. Let's start with the triple top. It's a pattern where price forms 3 highs at roughly the same level before reversing lower. It must appear at the end of an uptrend. That's the most important condition. If 3 similar highs form during a sideways range with no prior uptrend, it's not a triple top. Let's walk through how the pattern forms. Price rallies and hits strong resistance, forming the first high. It pulls back, bounces, and climbs again, only to get rejected at the same level. That's the second high. It pulls back once more, makes another attempt, and gets rejected again. That's the third high. The neckline is the line connecting the 2 lows that form each time price pulls back from a high. While the pattern is developing, the neckline acts as support. Price bounced near that level each time it came down, but after the 3rd high, buying pressure runs out, and price finally breaks below the neckline. At that moment, the neckline flips from support to resistance, and the pattern is complete. A candle closing below the neckline on a closing price basis confirms the pattern. The triple bottom is the mirror image. Price forms 3 lows at roughly the same level before reversing higher. It appears at the end of a downtrend. 3 touches at the same level means there are more buyers than sellers below that price. The neckline is the line connecting the 2 highs that form each time price bounces off a low. A candle closing above the neckline confirms the pattern. The structure is the same as a double top or double bottom. The difference is that support and resistance have been tested one more time at the same level. That additional confirmation tends to produce a cleaner, more decisive move once the neckline breaks. One thing worth noting: the 3 highs or lows don't need to be at exactly the same price. If they're at a similar level based on candle bodies, that's close enough. Crypto in particular tends to show more jagged price action than traditional markets, so the highs and lows won't always align perfectly. As long as the overall level is similar, the pattern holds. If the variance is too wide, don't force it. Look for the pattern on at least the 1-hour chart. Reliability increases as you move up to the 4-hour or daily time frame. Strategy 1. Neckline breakout. This is the most straightforward entry method. You enter directly at the point where price breaks through the neckline. Let's walk through it using the triple top. Wait for the 3 highs to form and for price to approach the neckline. When a candle closes below the neckline on a closing price basis, enter short. Stop loss goes 1 to 2% above the third high. Your take profit target is measured by projecting the height of the pattern downward from the neckline. For example, if the high is 10,000 USDT and the neckline is 9,000 USDT, the pattern height is 1,000 USDT. Your take profit target is 8,000 USDT, 1,000 USDT below the neckline. Apply the same logic in reverse for the triple bottom. Enter long when a candle closes above the neckline. Stop loss goes 1 to 2% below the third low. Take profit is the pattern height projected upward from the neckline. Always check volume alongside the breakout. Volume should increase noticeably at the point of the neckline break. A quiet break with no volume spike is often a false breakout. Crypto markets are especially prone to false breakouts during low liquidity hours. Always wait for the candle to fully close before entering. One more thing to be aware of. The neckline isn't always perfectly horizontal. If the two lows or highs that form the neckline are at slightly different levels, the neckline will have a slight slope. In that case, still use the same rule. Judge based on whether price closes clearly on the other side of that line. Strategy 2. Pullback re-entry. This is a lower risk approach than the first strategy. Instead of entering immediately at the breakout, you wait for price to pull back to the neckline before entering, using the triple top as the example. After price breaks below the neckline, it sometimes bounces back up toward that level. At that point, you watch for the neckline to act as resistance, the former support flipping to resistance. When price touches the neckline and gets rejected, enter short on the close of that candle. Stop loss stays tight, within 1% above the neckline. Take profit is the same as strategy 1, the pattern height measured downward. For the triple bottom, wait for the neckline to hold as support after the breakout, then enter long. The pullback doesn't always come. You may miss the entry entirely, that's the trade-off. But you're entering from a confirmed level, which keeps your risk lower. There's another advantage to this approach. Entering right at the breakout sometimes forces you to set a wider stop because of immediate volatility. With a retest entry, your stop sits just above or below the neckline, which is much tighter. Same take profit, tighter stop, that improves your risk to reward ratio. In this strategy, also check volume during the pullback and at the retest. Ideally, volume contracts as price pulls back quietly to the neckline, then picks up again as it gets rejected. Strategy 3. Volume plus multi-timeframe confirmation. This is the highest reliability approach of the three. Instead of relying on the pattern alone, you stack multiple conditions before entering. There are 3 conditions. First, volume should be declining as the third high or low forms. Ideally, volume is highest at the first high and decreases with each subsequent high. That's a sign that momentum is fading. Weakening buying or selling pressure raises the probability of a reversal. Second, the higher time frame must agree with your direction. If you see a triple top on the 4-hour chart, check whether the daily chart is also in a downtrend. If the higher time frame is pointing in the opposite direction, hold off on the trade. Going against the larger trend increases your risk. Third, volume at the neckline break should be at least 1.5 times the average. Enter only when all 3 conditions are met. For a short entry on the triple top, stop loss goes 1% above the third high, and take profit targets 1.5 times the pattern height. For a long entry on the triple bottom, stop loss goes 1% below the third low, and take profit targets 1.5 times the pattern height. The conditions are stricter, so setups will come up less often. But when they do, the risk-to-reward ratio is higher than with the first 2 strategies. You may not find setups that check all 3 boxes very often. Waiting for those setups is the whole point of this strategy. If only 2 conditions line up and the third is unclear, pass on the trade. Forcing the conditions defeats the purpose. At that point, you're just running strategy 1 with extra steps. Sticking to your criteria comes before chasing returns. Let's wrap up today's 3 strategies. Strategy 1. The neckline breakout. Enter after confirming a neckline close and a volume increase. Strategy 2. The pullback re-entry. Wait for price to retest the neckline after the break. Confirm the support to resistance flip, then enter. Strategy 3. Volume and multi-timeframe confirmation. Fading volume, higher timeframe alignment, and a volume spike at the break. Confirm all 3 before entering. This is the highest reliability approach. If you want more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If today's video was helpful, please like and subscribe. Thank you.